Building a portfolio that grows passively is one of the smartest ways to secure your financial future. Instead of constantly making trades or worrying about market movements, a well-built portfolio can help your money grow on its own. This is especially important if you want to reach your financial goals without needing to actively manage your investments every day. In this video, we'll talk about 5 top ETFs for 2025. These ETFs are selected because they target growth, stability, and diversification. 3 key factors that will help you build a strong financial foundation for the future. Whether you're new to investing or you're just looking to refine your strategy, these ETFs are a great starting point. They give you access to different industries and types of companies, helping you spread your risk while giving you the potential for significant returns. Let's dive into each of these ETFs and why they're a good fit for anyone looking to make smart, long-term investments in 2025. If you're planning to invest for the long term and you're okay with a bit of market risk, growth ETFs are a great choice. These ETFs focus on companies that are expected to grow at a faster pace than the market. While growth stocks can be more volatile, they also have the potential to bring in higher returns over time. This makes them perfect for investors who have a longer time horizon and can afford to ride out market fluctuations. Growth ETFs typically invest in companies within industries like technology, healthcare, and consumer services, sectors that are constantly innovating and expanding. Since the goal is to hold these stocks for a long period, you don't have to worry about daily market movements. As long as the companies in the ETF continue to grow, your investment will likely grow as well. Here are a few of the top growth-focused ETFs for 2025. SCHG, Charles Schwab, U.S. Large Cap Growth ETF, QQQ, Invesco QQQ Trust, SMH, VanEck Semiconductor ETF, VGT, Vanguard Information Technology ETF. Each of these ETFs focuses on different sectors, but they all share the same goal: to give you exposure to high-growth companies that are expected to outperform the market over time. Now let's break down SCHG as an example. SCHG is one of the most popular growth ETFs because it focuses on large-cap U.S. companies that have strong growth potential. The ETF is designed for investors who want to capture the performance of top-performing companies in the U.S. Expense ratio 0.04%. This is incredibly low, which means you get to keep more of your returns. In simple terms, an expense ratio is the cost of owning the ETF, and SCHG's low expense ratio makes it a cost-effective choice. Annual returns. Over the past 10 years, SCHG has returned about 16% per year on average. Over the past 5 years, it's been even stronger, at around 19% per year. This performance shows that SCHG has been able to consistently grow, making it a solid choice for long-term investors. Key holdings. SCHG invests in some of the most well-known and successful companies in the world. These include NVIDIA, a leader in the semiconductor industry, known for its cutting-edge graphics cards and AI technology. Apple, a tech giant that continues to innovate in consumer electronics and services. Microsoft, a leader in software, cloud computing, and artificial intelligence. Amazon, the world's largest online retailer and a major player in cloud computing. Meta, formerly Facebook, a leader in social media, virtual reality, and digital advertising. The combination of these high-growth companies makes SCHG a strong growth-focused ETF. If you're looking for an ETF that offers exposure to large, successful companies with the potential for long-term growth, SCHG is a great option. Keep in mind that while the returns have been impressive, like all growth investments, it's important to be prepared for some ups and downs along the way. But if you hold for the long term, the growth potential is there. The Avantis U.S. Small Cap Value ETF, AVUV, focuses on small cap value stocks, which are stocks of smaller companies that may be undervalued by the market. Small cap stocks are typically companies with a market capitalization of less than $2 billion. While these companies are often overlooked by larger institutional investors, they can offer tremendous growth potential. For investors looking to make high returns, small cap stocks are a great option, but it's important to note that they tend to be more volatile than larger companies. This can lead to greater risks, but also greater rewards. Small cap stocks tend to do very well when the economic environment is favorable, especially when interest rates are low. When interest rates drop or the economy slows down, small cap stocks can benefit. In these situations, smaller companies often find it easier to borrow money for expansion, which can lead to faster growth. This is particularly beneficial in times when central banks, like the Federal Reserve, cut interest rates. The growth of small companies can help drive the overall economy forward, making this ETF an appealing option if you believe 2025 will be a time of low interest rates or economic recovery. Here are the key details about AVUV that you need to know. Expense ratio, 0.25%. This is the cost you'll pay for owning the ETF each year. While 0.25% is higher than some larger, more established ETFs like SCHG, it is still relatively low when compared to many actively managed funds. The value of the ETF's holdings could easily outweigh this cost if the ETF performs well over time. Annual returns. Since its launch, AVUV has delivered around 15% annual returns. While this may not sound like a massive return compared to some high-growth ETFs, it's important to keep in mind that small-cap value stocks tend to have a higher risk and a higher potential for returns in the long term. 15% annual returns since inception is still an impressive performance, especially for small-cap stocks, which tend to be more volatile. Diversified holdings. AVUV offers a diverse mix of small-cap value stocks spread across different industries. This diversification helps spread risk, as the ETF doesn't rely on the performance of just one sector. Some of the key sectors included in AVUV are O financials. This includes small banks, insurance companies, and investment firms. Small financial institutions often grow rapidly when interest rates fall, as they can lend money at cheaper rates. With a strong economy, these companies can perform very well, providing good returns for investors. O industrials. This sector includes small manufacturing companies, construction businesses, and infrastructure-related firms. As the economy grows and demand for goods and services increases, small industrial companies often see strong growth. AVUV taps into this growth by investing in these smaller but potentially high-reward industrial companies. O consumer discretionary. These are companies that sell non-essential goods and services, like retail, travel, and entertainment. In a growing economy, people have more disposable income to spend on things they want rather than just what they need. Small companies in the consumer discretionary sector can see significant growth during these times, making them valuable holdings for AVUV. By investing in AVUV, you're tapping into the potential of small companies across different industries. Small-cap stocks often go through more significant swings in price than large companies, but they also have greater opportunities for growth, especially in a favorable economic environment. If you're looking for an ETF that offers a bit more risk and reward, and you believe that 2025 will offer a good economic climate for small businesses, AVUV might be the perfect choice. Keep in mind, small-cap stocks can be more volatile, so it's important to be comfortable with the ups and downs that may come with investing in this ETF. However, if you're patient and have a long-term view, the potential rewards can make it a very worthwhile addition to your portfolio. For those interested in adding cryptocurrency to their portfolio, the iShares Bitcoin Trust, IBIT, provides a straightforward way to invest in Bitcoin without the need to directly buy or manage the cryptocurrency. Cryptocurrency can be a powerful addition to a portfolio, especially for investors looking for high-risk, high-reward opportunities. Bitcoin, in particular, is seen by many as a store of value and a potential hedge against inflation. However, buying Bitcoin directly can be complex and comes with security risks. With IBIT, you can invest in Bitcoin through an ETF, which simplifies the process and provides exposure to Bitcoin's potential growth. Here are the key details about IBIT. Expense ratio, 1.2%. The expense ratio is higher compared to some other ETFs, reflecting the costs associated with managing a crypto-based investment. While 1.2% might seem high, it's important to remember that this is for an asset class that can experience massive price swings. The cost may be worth it if Bitcoin continues to grow and increase in value. Bitcoin's potential growth. Bitcoin has seen incredible growth over the past decade and continues to be a key player in the cryptocurrency world. As more people in the US and worldwide adopt cryptocurrency, Bitcoin's potential for growth remains strong. Many investors see Bitcoin as a digital gold that could serve as a safe haven for wealth, especially during uncertain times. Crypto adoption in the U.S. The growing adoption of cryptocurrencies in the U.S. makes Bitcoin a highly relevant investment. More businesses and individuals are integrating Bitcoin into their financial systems. and this trend is expected to continue in 2025 and beyond. As adoption increases, the demand for Bitcoin could rise, driving up its price and benefiting investors in IBIT. Recommendation: while Bitcoin and other cryptocurrencies can offer massive returns, they come with high volatility and risk. For most investors, it's recommended to limit your crypto exposure to around 2.5% to 5% of your overall portfolio. This ensures that you're not overly exposed to the risk that comes with cryptocurrencies, while still giving you the opportunity to benefit from their potential growth. The iShares Bitcoin Trust, IBT, is a great option for those who want to get exposure to Bitcoin, but prefer the ease and security of an ETF. If you're comfortable with the risk and want to take advantage of the growing popularity of cryptocurrencies, IBIT could be a valuable addition to your portfolio in 2025. Broad market ETFs are an excellent option for investors seeking diversification and stable returns. These ETFs aim to track the overall market or major indexes, such as the S&P 500, and include a wide range of companies from various industries. The key advantage of broad market ETFs is that they offer exposure to a large number of companies, spreading risk across different sectors, and reducing the impact of any one stock's performance. This makes them a great choice for long-term investors looking for steady growth with less risk. Popular broad market ETFs include options like VOO, VTI, Vermont, and SPLG, which track different indexes but have similar strategies. These ETFs give investors exposure to some of the largest and most established companies in the market, making them a great option for building a balanced portfolio. Let's focus on VEOO, Vanguard S&P 500 ETF. Expense ratio, 0.03%. VOO has one of the lowest expense ratios in the industry, meaning it's very cost-effective for investors. With such a low fee, you keep more of your investment returns over time. Annual returns. Over the past 10 years, VOO has returned around 13% per year on average, and about 15% over the past 5 years. While this return might not be as high as some specialized growth ETFs, it is still very strong, especially given the stability that broad market ETFs offer. Tracks S&P 500. VO tracks the performance of the S&P 500 index, which is made up of the 500 largest U.S. companies. This means that when you invest in VEO, you're essentially investing in some of the most well-established and financially strong companies in the world. Some of its top holdings include Apple, Microsoft, Amazon. These companies are leaders in their industries and have been delivering steady growth for years. Investing in VOO gives you a piece of these powerhouse companies while also diversifying across other top companies in the U.S. stock market. Why VOO is a great choice for 2025. VO is perfect for investors who want a low-cost, low-maintenance investment that offers diversification and consistent returns. The S&P 500 includes a mix of growth and stability, making VOO a good option for investors who want to avoid the high volatility of smaller stocks or cryptocurrencies, but still want to benefit from the overall market's growth. VOO is a great ETF to consider for building a long-term, steady portfolio that can grow alongside the overall U.S. economy. In 2025, with an uncertain economic outlook, having a broad market ETF like VO in your portfolio can help reduce risk while still positioning you for solid returns over time. If you want stability and steady growth, VO is a top ETF to consider. Dividend ETFs are a great option for investors seeking reliable passive income along with the potential for long-term wealth accumulation. These ETFs invest in companies that regularly pay dividends, providing investors with steady income from their investments. This makes dividend ETFs particularly appealing to those who want to generate income while also benefiting from the long-term growth of their investments. The Charles Schwab Dividend Equity ETF, SCHD, is a top choice for dividend-seeking investors. It focuses on high-quality companies that have a history of paying consistent and growing dividends. Dividend-paying stocks can be more stable than high-growth stocks, making SCHD a solid pick for those looking to balance income generation and capital appreciation. Here are the key details about SCHD expense ratio, 0.06%. SCHD has a very low expense ratio, meaning it won't eat into your returns too much. This is a great option for those who want to minimize fees and maximize their income from dividends. Dividend yield, approximately 3.4%. This means that for every $100 you invest in SCHD, you can expect to earn around $3.40 annually in dividend income. While this may not be as high as some other dividend ETFs, it's still a solid yield and comes from companies with strong financials and stable dividend payouts. Key features: diversification. SCHD provides exposure to a broad range of sectors, including financials, healthcare, and consumer staples. This diversification helps reduce risk, as the ETF's performance is not reliant on just one sector or industry. Financials. The ETF includes companies like banks, insurance firms, and investment companies, which tend to do well when the economy is strong. Healthcare. This sector provides stability and growth, especially in times of uncertainty, as healthcare companies often see consistent demand. Consumer staples. Companies in this sector produce everyday goods like food and household products, which people continue to buy even in tough economic times. Annual returns. Over the past 5 years, SCHD has delivered an average return of around 12% per year, and over the past 10 years, it has returned around 11% per year. These returns show that SCHD not only provides reliable dividend income, but also strong long-term growth. Why SCHD is a great choice for 2025. For investors who want to generate passive income while also benefiting from long-term wealth growth, SCHD is an excellent pick. With its low expense ratio, strong dividend yield, and diversified holdings, SCHD offers a balance of stability and growth. It is particularly well suited for income-seeking investors who want to ensure their portfolios are growing while also generating consistent cash flow. To recap, we've discussed 5 top ETFs for 2025 that target growth, stability, and diversification. Growth ETF, SCHG, Charles Schwab. Small Cap, Value ETF, AVUV, Avantis. Bitcoin ETF, IBIT, iShares Bitcoin Trust. Broad Market ETF, VIAT, Vanguard S&P 500 ETF. Dividend ETF, SCHD, Charles Schwab Dividend Equity ETF. Each of these ETFs offers something unique for different types of investors, whether you're focused on growth, income, or stability. The key is to choose the ETFs that best align with your investment goals for 2025 and beyond. Feel free to share your thoughts and let me know which of these ETFs you're most interested in for your portfolio. Don't forget to subscribe for more insightful content on the best investment opportunities.